Hey folks, welcome back to the channel. This is Jason. Thanks for tuning in today. And if this is your first time tuning in, feel free to comment away. I like to address questions. I like audience participation. Normally what I do is just start off by talking about something topical concerning the market or economics, and we drift off into whatever you guys want to talk about. No different today. Did want to talk about one thing in particular right now is that I am a little bit less optimistic about market turnaround this year. And it actually doesn't have as much to do with the underlying economy and demand as it has to do with where fixed income is going right now. What I'm really talking about is money market rates. High yields, according to this headline, are great for savers, but a pain for everyone else. Really, because it offers an alternative to making money in stocks. So one of the things that a lot of people don't realize is that a lot of the money that's in the stock market is tied to pension funds and target return funds, where a fund may have a stated goal of 5%, a fund may have a stated goal of 7%, and they want to get that to achieve that return by taking the least amount of risk possible. Now that money market rates are around 4.5%, I think I looked at Vanguard's money market rate today, it's close to 4.7%. A lot of those return concerns are going to be alleviated by banks going into really short-term government securities like 3-month T-bills or something, and that money is not going to be going back into the stock market to take advantage of market lows. So that money is not going to be flowing back into stocks. So we're going to see a bit more of a bifurcation of dollars across the bond and stock market than we have seen both on the institutional side and on the retail side going forward for as long as interest rates remain high. Now, it is the case, I believe, that we will likely see a pause in the rise in interest rates this year. I know that the market is probably betting on a little bit of a turnaround and actually declining interest rates by the end of the year. I don't know that we see a substantial decline in interest rates. I think that when the Fed does decide to pause, and if they decide, and that's a big if they decide to ratchet back on interest rates, it's going to be a quarter point per quarter. It's going to be a very slow pace of unwinding of the Fed's policy, and of course the Fed's balance sheet as well. So there's a lot going on there that causes me to be a little bit more concerned. And I think that everyone who is an investor should be a little bit more cautious, and you should be thinking a little bit more traditionally about your investment portfolio going forward, and think about adding something. So just want to acknowledge a couple of my regulars. Shooters Joe, thank you very much for tuning in. And of course, tell 666-999. Like I said, no need to limit yourself. If you guys have questions or comments, go ahead and let me know. So big news today, which is not as big a news as everyone seems to be making out to be in financial media, is that job cuts came in a little bit above expected. I think it was only 4,000 or 6,000 more expected. So initial jobless claims are about 197,000. And I think that it was somewhere between 191 and 192 is what was expected. So you're looking at jobless cuts or jobless rates increasing by about 3% more than expected, which I don't think this is. I mean, it's good news. It's news that maybe we're moving in the right direction, at least for this week. But 1 week, of course, does not make a trend. And I want to see what's going on in terms of total employment. I will say that it seems like on the surface that the tech industry at least is making all of the headlines when it comes to job cuts. And those are some very high paying jobs. But it doesn't seem to be reflected all the way across the economy, which is what I think that the Federal Reserve is more interested in at this point. So we have seen a pretty substantial increase in money market holdings for the last year or so, going up by about 35% just in the last year or so. Indication that people are finding cash as a reasonable alternative. So let me see here. Okay, Q1, question one, do we need a recession? Yes, it will be bad if one happens, but it seems inevitable. I Well, there's a couple of ways to answer that. Muhammad Al Aryan was talking about this trilemma today on Twitter, where the trilemma is inflation, of course, it is profits, and it is credit quality, right? Or at least I think that's what he said. I read it early this morning, and that is kind of the big issue here. Is that if the Fed wants to battle inflation, they have to raise interest rates. That means that credit is going to be trimmed back. That is going to affect growth. So it was inflation, growth, and credit is what he was talking about. That's the trilemma right now. And there's no way to solve all three of those issues without some degree of pain. The Fed has already chosen their path. They are absolutely going to raise interest rates until they think that inflation has been tamed. They are completely willing to sacrifice the economy, to sacrifice millions of jobs to do that. And they don't really care whether or not your 401k is doing well. So, do they intend to have a recession? It depends on what you call a recession. I think that they probably, and they stated this, that they would like to see unemployment somewhere around the 5% level, which is higher than the roughly 3.4% level that it is today. That translates into several million jobs disappearing. So it's not nothing, especially if you were one of those several million jobs that is disappearing. So, in terms of the tech industry, I do know a ton of people in the tech industry, including a lot of people that have got laid off recently. They're all basically working, or they're fielding multiple offers at this time, waiting to see which offer that they actually want to take and start working on. So we haven't seen we've seen a lot of companies preemptively trimming staff in order to reduce expenses, thinking that if we go into a recession, it's not going to look as bad on quarterly reports in terms of cash flow. But we're seeing these people get picked up in other positions as well. So I'm not sure that unemployment is really entirely going the direction that the Federal Reserve would like it to go. Cindy Haynes says, "Hi, Jason." Hi, Cindy. How's it going? Haven't heard from you in a long time. Yeah, and that's a friend of mine from, I don't know, like almost 30 years ago. So very interesting that she's tuning into one of my live streams today. And but yeah, thank you very much. So is it going to be a bad one if we have a recession though? I actually don't think that it's going to be a very bad one if we do have a recession. In terms of fighting a recession, let's remember that there's the huge thing that the Federal Reserve has is the ability to create more liquidity by selling government bonds. They have almost 9 trillion or $8 trillion of bonds on their balance sheet right now. They're able to create liquidity to begin with by selling more government bonds, by purchasing, which is not something they want, but that's what they can do without trying to directly manipulate the market by actually raising or lowering interest rates. So which way that would go, meaning do they stick to their balance sheet roll off and continue to keep interest rates high in order to combat inflation? Do they seek to sell government bonds, therefore putting more bonds on their balance sheet in order to create more liquidity to prevent a recession? I don't think that's the path that they're going to go. I think that they're going to manage what I think is a recession. They're not afraid of the word recession. They would prefer not to have one. I think they're afraid to actually have a recession that lasts 2, 3, 4 quarters. So it's like a dilemma they are having issues with right now, which is inflation, growth, and credit quality, and credit markets and credit quality of different companies that are out there. So that's going to be one of the big deals. Did you guys see the news about Disney and their management district? I forget what it's called. Oh, the Reedy Creek Development District or whatever. How they kind of quietly stripped all the power away from that development district and handed it over to Disney in a multi-decade agreement, all over the power. So it was one of the big things that I didn't understand about politics and the way that was run and how it was going to affect business. And I was very concerned with how this would affect, because I do own Disney stock. I was very concerned with how this would affect Disney stocks. I'm suddenly completely unconcerned. And for a lot of ways, it means that the state government is not going to be able to interfere in Disney's business for very long, no matter, or for at all, really, no matter who's in charge. One of the things that's very good overall for the economy of Florida, which is a very important part of the United States' economy. A lot of people don't necessarily think about that, but it actually is. So a couple of things going on right now in in banks that I'd like to talk about too. I don't know if you guys caught my video earlier today about the new banking crisis. It's not new. I mean, everyone knows about it, but it's a slow moving apocalypse that's going to happen over the next 5 to 10 years as we start to see commercial leases come due, office leases come due. Office occupancy rates are not returning to that 100% level that they were in 2019. At the beginning of the pandemic, I kind of made the prediction that about 30% of the people that went home and started working from home were never going to come back to the office. That's just how it was going to be. I was wrong about that. I think that 50% is probably going to be the new norm, and that hybrid working environments are probably going to be the new norm. As I was looking through all of the studies that are done and the data that is coming about office occupancy, Mondays and Fridays, essentially no one's in the office. Tuesday, Wednesday, Thursday are the days that people want to show up at the office. What we're probably going to see is workforces that are alternating between a 3-day work week from in the office, 2 days at home, and some people that work 2 days in the office, 3 days at home. And we're going to see a lot of office sharing, which means that these companies are going to need 50% of the office space that they have now. They absolutely can't get out of their commercial leases because that's just really hard to do. But when those commercial leases come up for renewal, they aren't going to renew them at greater than the office space that they need. And they're going to be able to add staff, like completely work at home staff, or just add to the rotation in terms of when they're in the office. We are seeing a collapse in office space. This is going to affect office REITs, really heavily going to affect us office REITs, and it's going to affect banks kind of all across the spectrum here, but it's not going to be evenly distributed. There are many banks that have no exposure to this sort of office capital. So the big deal is there's a lot of banks make money by continually refinancing the deals that these office buildings have when it comes to finance, and it's all based on cash flow. If cash flow is reduced 5, 10, 15% a year over the next 10 years for these guys, as we have fewer and fewer offices that are needed by these companies, the cash flow is not going to look good enough for them to be able to refinance those loans. And then that's when we start to see these loan defaults because they're not able to refinance. Additionally, the way a REIT expands, because they have to pass on 90% of what they earn to the consumer, to the person who owns the shares, in order to qualify as a real estate investment trust. They can only retain about 10% of their earnings. It doesn't leave them a lot to invest in new profits, to expand their business and raise their dividends, and it decreases the value of the stock if it's not growing. And the reason this is a big concern is that the cost of capital is so much higher now, and some of the major buildings that they used to invest in are no longer going to drive profits. They're going to have to do it some other way. I've been saying for a while that retail REITs are in trouble, and if you're going to go into a retail REIT, you want to look at something that's concentrated on those giant big box stores that aren't going anywhere. Something like a Home Depot, which does just as much business commercially with contractors as it does with individuals, or something like a Lowe's or a Walmart, a physical location for a Walmart. Businesses or REITs that deal in those type of businesses. Your REITs that own a dozen strip malls somewhere, they're in trouble. Even the ones that own shopping, they're in trouble. Like realty income tends to focus on single unit, really large tenants like those Lowe's and like those Home Depots. And they're going to be probably okay. But many other real estate investment trusts are going to go through a pretty heavy reckoning here in the next couple of years. So let me see here. Occupancy rates where I work, they're reducing office footprint. When I go in, it's so quiet, and not renewing leases and leasing smaller spaces. Yeah, that's the future of office space. And suggested on a live stream a couple of weeks ago that some of this office space might be turned into housing, which would reduce pressure on housing and housing costs in some of these areas. That may be true. It may be really difficult to do and take longer, though, because of permitting processes. The way you build, especially all the plumbing that goes into it, the way you build a building to handle an office and the way you build it to handle housing units are very different. Some metropolitan areas have really clear guidelines on how to convert buildings to make them into residential spaces, and some of them do not. So this is going to be an uneven process when it does occur, and I'm predicting that it does occur. You're going to see some office buildings convert into mixed use type of buildings in order to stay in business. But how this is going to work is really uncertain, guys. I don't know what the future holds in terms of that. And when I say something is uncertain, I don't know what the future holds. It's usually going to be something that I prefer not to hold in my portfolio beyond, 1-2% here and there. So um, the job market is really strange in the UK at the moment. My company is really struggling to fill vacancies, which has never happened before. And I'm getting a mixed picture. Man, I am in the flight path of the military helicopters today. It kind of just depends on weather conditions, but they're all over. I hope you guys can't hear that on the live stream. Yeah, so I'm hearing sort of mixed reviews when it comes to job vacancies. Like I know people who have just finished from coding school who are having real problems finding jobs. I know people with 1 or 2 experience in the technology industry now, and they're having no problems whatsoever finding jobs. On the service end in hospitality, restaurants, and that sort of thing. I'm also hearing the mixed bag. It's hard to find good people, and when you do find good people, it's hard to keep them because they're constantly getting better offers other places. So I'm not really encouraged by the greater filings for unemployment that we had this week. 1 week does not make a trend. And until we start to see a reduction in employment, then I don't think that we see real improvements in inflation the way that the Federal Reserve is looking at it. The big news, though, in terms of inflation, is that we have seen a decline in housing prices now for the last like 4 months in a row, and for rents, the decline has been like 5 months in a row now. Although it's getting a little bit smaller, but some of that is seasonally adjusted. We'll have to see what rent inflation looks like in the summer months and going into September, October, and then that'll give us a better idea of what that really looks like. And honestly, when you look at the CPI and the PCE, rent is either 17% of the calculation in one of those, and it's 35% in the second one. So it is a huge portion of what the Federal Reserve is looking at when they talk about inflation. So one of the things I'm hearing chatter about now that I haven't heard for a number of years is junk bonds. I had a couple of people ask me direct questions about junk bonds right now. And weirdly enough, and this must have been a topic on TikTok or a topic on Facebook or a topic on Reddit or something like that. People are asking me very specific questions about individual companies. Like, hey, I want to go out and buy bonds from this company. Man, that's like really weird. I haven't had retail investors do that for, I don't know, 15 years or so. They haven't asked me about that. I would not even think about buying individual issues. Go out and buy a high yield bond fund. That's what a junk bond fund has been called now for the last 20 years or so. They stopped using the word junk bond and now they call them high yield bonds. But yeah, so this is the first time I've heard this in 15 or 20 years. And I think it has more to do with social media than the actual opportunity in junk bonds. The other thing that is concerning for me is that we haven't reached the point now where there's this giant spread in what you make by buying a junk bond versus what you make buying a treasury. It really hasn't peaked at this point. So now would not really be the time to sort of make those investments anyway. Yeah. So okay. So Mac Bars, thank you very much for listening live. Although I do think I've seen your username somewhere else before. Fire away if you have any questions. We're at about the 18-minute mark here, and I didn't have a lot specific that I wanted to talk about today. I was just hoping that you guys would have some questions. Let me see here. Ford hikes prices on the F-150 Lightning as production resumes after the EV battery fire. You can expect more of those. So this is actually interesting news that I want to address this in a way that's non-political. Judge strikes down Obamacare coverage for preventative care for cancer, diabetes, HIV, and other conditions. So it really doesn't matter whether or not the judge is striking down coverage. What they mean is that you can't force companies to provide this coverage for free. But they're going to provide it for free anyway. And let me tell you why. Because this preventative care and preventative maintenance is the easiest way to defray really long-term costs. Now, back in the day when I can't remember where I worked for, but it was a really small company that I was contracting at in Texas somewhere, and everyone there didn't have insurance. They had to own their own insurance. But one guy was about my age now. He's in his late 40s, early 50s, and he suddenly developed type 2 diabetes. He calls in, makes a doctor's appointment, goes to the doctor. Doctor says you have type 2 diabetes. He gets a call from his insurance company like 3 days later, and they say, we're dropping your coverage. And that was perfectly legal back then. If you developed diabetes, they could drop your coverage. You are too expensive to maintain as an insurance risk. An insurance risk is about insuring against things that might happen, not insuring against things that will happen. Insuring against a catastrophic loss that you have a chance of not assuming, right? In terms of insurance, that's not an insurable risk. If you have type 2 diabetes, there will be complications and it will cost them more money to insure you. So all of those rules were changed beginning around the year 2000 through about 2014, and you can't do that anymore, right? But the companies are going to continue giving you coverage for preventative care for cancer, diabetes, and HIV and other conditions because it's the best way to save money, right? And that's the thing. It's like the reason they offer you all of these pre-screenings for cancer is because if they can solve the problem early, it saves the companies vast amounts of money. And that's kind of, and this is decision in a way is important, but it may be less important than you think. This is one of the ways that the market is really going to take care of this. They all know this. So this is called pre-exposure prophylaxis. And the real issue here is that a couple of organizations sued. They were religious organizations that sued. They didn't want to for them to be forced to provide coverage for HIV prevention. And the companies are the insurance companies are likely to do this anyway. Like I said, is it cheaper to give someone a preventative drug for HIV, or is it cheaper to actually pay for their care for their entire life? Uh, Back to the stock, pretty close week. I have zero faith that this 3-week high is going to stick at this point. I think that the market for this time around in this period is still right around 3,800. We are going to touch that again before the end of January 30th. I got a quick update yesterday on where the negotiations are for budget and for the debt ceiling. And the quick update is that there are no negotiations right now for budget and debt ceiling. In fact, Speaker of the House and President have not met for 2 months rather to discuss this. Both sides are completely willing to let this go down to the wire and to let uncertainty set into the market. So be prepared for that. Be prepared for more market mini crashes here in the near future that are driven by politics and not by fundamentals. And I think that as long as you're prepared for that, you're prepared to ride through it as well. So for me, it seems like the Bank of England follows the Fed, just timing of interest rates and announcements. Hindsight, central banks could have done better. Yeah, the Bank of England follows the Fed, but not because they're following Fed policy. It's because they have to. Right now, interest rates on 2 to 10-year debt in the United States are a lot higher. Yields are a lot higher here in the United States than they are overseas, which means that investment dollars are going to be flowing out of England, out of Great Britain, and out of the European Union, and coming to the United States because number one, in terms of credit quality, the United States is a great bet. But number two, interest rates are just higher. It's 1% annual. You compound that over a 10-year time period. It's quite a big deal. And also, there's more going into that. Remember, we will probably be the first ones to cut our interest rates as well. So you're buying fixed income right now at depressed prices and increased yields. And when interest rates drop later on, you're able to offload that first and to bring that money back to the EU or to the UK, wherever you are. So it's not that they're following policy. It's that they don't have a choice if they want to keep investment dollars in their respective countries. So, and this is something that I hear over and over and over from people who aren't really thinking in terms of an investor. They're really just thinking about, whether their country is leading in policy or whatever. It really isn't that way. It's a couple of things that are considered when you're investing in sovereign debt. Number one is the claims paying ability of the country that you're buying the debt from. The United States is fairly solid. When I say fairly solid, we've never failed to pay on our debt. And the other thing is the yield that you're expected to get and sort of the timing of when you think interest rates are going to rise and fall. So a couple of, one other thing going on there that I've mentioned before on this live stream is that the United States exports recessions, but we don't import them. We have made our recessions contagious continuously throughout the last 100 years or so, but it's never been the case that the United States has caught a recession cold from internationally. That has never happened. So that's the other reason why you kind of want to front run things with U.S. treasuries rather in times of trouble, rather than sticking with even some countries that have a great track record of paying back their debt. But Germany's debt is really low right now in terms of yield. Spain's debt is really low right now in terms of yield. Italy's is a little bit higher. Great Britain's debt is a little bit higher than Germany's, but not that much higher. But the United States is an outlier right now. Our 10-year debt is close to 3. It's 3.55 today. It was close to 4 last week. So that's kind of what's going on there. Is like the Bank of England has to raise interest rates. They would probably prefer not to. Let me see. What general advice can you offer someone who has a bonus coming at the end of April? Can you talk a little bit more about what you mean by traditional picks? So what I mean by traditional picks is you should probably start thinking less about the risky tech stocks right now and start loading up on companies that are showing good or that are showing great current cash flows. Number one, they're probably in the medium term, in the 3 to 5 year range, they're probably going to perform just as well as some of these really exciting tech picks that we have. The tech stocks are going to have a lot of trouble raising money based on their credit quality and market cap over the next couple of years until we see the cost of capital decrease. That is not going to be the case with some of these really large companies. They're still going to be able to go to bond markets and issue bonds. There are many fintechs out there that if they were to go out and issue a bond to raise money, they would be issuing at 8, 9, 10%, or they would not find willing buyers in the sort of institutional stage of that offer of bonds to the public. They wouldn't find people that were willing to take that risk, and they would have to do they would do what's called like a best efforts offer, which is a lot more expensive. It's very expensive. So there's a lot that goes on with the fixed income market that's not all that intuitive. And so that's kind of the thing that's going on there. But the more general advice that I could give you right now is not actually a bad time to take a look at those more traditional picks, things that are on the S&P 500 that would be considered like large cap value stocks. And things like Dow Chemical, Johnson & Johnson, take a look at closely at those, Caterpillar, that sort of thing. Caterpillar, it may not be the right time now. You really want a manufacturing slowdown and a building slowdown before you start thinking about buying into Caterpillar. But UPS would be a stock that you want to look at. Once again, folks, I got to remind folks that any individual stock that I talk about is not an endorsement to buy, sell, or hold any security. You got to do your own due diligence. And in this time period, you need to do more of it. Okay. There are a lot of companies out there that, based on the way that they report their earnings and the way that they report what they're involved in, if you're not reading between the lines, they are going to fool you about how much risk they're taking. So one of the things I'm looking at fintechs right now in terms of the amount of risk that they have on their balance sheets, how easy it is to securitize their loans. And you look at a bank like fintech or like SoFi, that pretty much only has very like $100 million in home loans that they've made in the last couple of years. And they've made $12 billion in loans, in unsecured personal loans and in student loan refinancing, right? But those unsecured personal loans and student loan refinancing, those are done in much smaller amounts, and you have a much wider selection of the population there. And this is a high credit selection of the population. And you're looking at probably that's something that on balance, the risk is actually going to be lower than some regional small banks who are heavily invested in small business loans, that are heavily invested in loans to retail customers, and actually home loans. People do not think of home loans as being high risk, but home loans are actually fairly high risk. Who actually keeps the same job for 30 years? Who doesn't run into problems for 30 years? Who doesn't get a divorce in 30 years? If you try to satisfy all three of those, it's actually a fairly small amount of people. So that's the other reason that banks tend to securitize those loans and get them off of their balance sheet as well. They try to make as many loans as they can across the spectrum of credit quality, and while keeping their credit quality as high as possible. So yeah. Let me see here. Tell 66699 says, I'm loading up on Tesla. So Tesla already makes up a significant portion of my overall net worth. So I'm definitely not loading up on Tesla. I really can't add any more without becoming more than 10% of my entire net worth. So I'm not doing that. I do think it's a very good long-term bet. But at this point right now, oh, yes, this is a big story. Let me see here. The a shortage in construction labor is seen to continue in Los Angeles, especially plumbers, electricians, painters, and recession seems regional to me. That's actually kind of the case everywhere right now. There is no shortage of job offers for construction laborers anywhere in the United States, as far as I can find. In fact, there's a giant battery factory that's supposed to be built in Ohio, and they're having a heck of a time finding people to build this factory in Ohio. They need about 7,000 people. They're going to be constructing this factory for like 2 or 3 years. And I think it's supposed to provide about 1,400 or 1,500 permanent jobs, but they need 7,000 laborers to build this factory. They are not able to find them, even with some really attractive job offers because of where this is located. And so that is definitely the case here. But it's also the case that we, as the United States, have not done a very good job of training plumbers, electricians, and painters in the numbers that we need them, especially the plumbers and electricians. It's not an underpaid profession anymore like it was just 20 or 30 years ago. Like, I know people in rural Texas that work as plumbers and make $100,000 a year. While that's good money here where I live, that is real money where they live. I mean, that is real wealth. They're making more than a lot of professionals in that area. So you see here. Final question from me, Jason, and thanks for what you do, Alibaba. Breaking up their component parts is a good thing. Tobacco Cloud is great. Others, not so sure. So the prediction right now is that only some of those are probably going to IPO on U.S. markets, and the rest of them are going to IPO on the domestic Chinese market, and we won't have access to them directly anyway. You may be able to buy them as an international holding, paying a lot more in the way of fees through your brokerage. You may not. Is this a good thing or a bad thing? I think this is something that was probably forced onto them by the government. Rarely do you have cases where divestiture from a company like Alibaba that is controlled centrally like this. Rarely do you have the case where it's not forced by the government. I mean, we have some good cases recently, like GE splitting its business, but let's remember this is the umpteenth time that that GE has split its business. So let me see here. Read a story recently that said 300 million jobs can be impacted by Chat GPT, but construction would be one of those AI-proof jobs. Well, I don't actually know that construction would be AI-proof, particularly when you look at additive construction that's going on right now, like 3D printing and how that's going to evolve. So I'm not the biggest fan of Chat GPT right now. I have tried using it for a lot of things. But if you've ever read science reporting and then gone back and read the article, and then you realize that what the science reporter reported on the actual scientific article, one had nothing to do with the other. It's like someone writing a science piece on something that they can't really understand. This has kind of been my case with Chat GPT and tax issues. There are a couple of things that I looked up recently regarding tax issues on ChatGPT where I wanted a quick way to phrase it in a way that I thought the client would understand it. And the answer it came back with was actually either incomplete or incorrect. So Yeah, it was either incomplete or incorrect, and it was literally like a high school kid talking about tax issues that maybe they had read an article, but they didn't really understand the depth of it. I think that it takes a while for Chat GPT to evolve beyond let's deliver a product that a seventh grader can understand or will understand, and the depth of understanding they need, to something that's really truly professionally useful. Because if you are working in the tax industry and you're using ChatGPT to formulate responses, I can tell you right now, I find errors with that daily. When you're looking at, and particularly when it comes to like investments and taxes, there are errors with that daily. I haven't taken the time to like report those or anything like that, but I'm thinking about it. So, do you think the EV manufacturing charging stations will be negatively affected if a Republican president is elected? I don't really, and largely because the market has already decided that the battery electric future is the way to go. And I hear a couple of prominent sort of right wing financial YouTubers that are talking about how crazy it is and how much it's going to cost. And these people are obviously not up on technology, and they don't realize that within the next year or two, there's going to be a significant number of cars that are running on sodium ion batteries. Sodium ion batteries, in terms of energy density, charge time, and the ability to operate in extreme environments, they are already just as good as lithium iron phosphate batteries. So nothing in the lithium iron phosphate battery is supply constrained, other than the fact that there aren't enough people mining for them. But it's even better when you're looking at sodium ion batteries. So the highest end cars, you're still going to have that really expensive, like lithium, manganese, cobalt cathode chemistry for the highest end of vehicles out there. But for everything that's your everyday commuter, you're really looking at using a sodium ion battery is adding about 300 to 380 pounds onto the vehicle, and it's going to be just as efficient as the lithium iron phosphate batteries that are used by BYD right now and by Tesla for that are built at the Chinese factory and exported to Europe. It charges better in cold weather, and charge times are actually quicker than the lithium iron phosphate batteries. So let me give you an example here. The lithium that you can take and refine down to into a battery, as of October, I haven't looked at prices recently. We're like $88,000, per metric ton. It's $3,000 per metric ton for sodium. Okay, this is the way we're going. And not only that, sodium. There's no supply constraints with it whatsoever. Most of the research that was done on sodium ion, on lithium ion batteries, can also be applied to lithium ion batteries. There's been a recent breakthrough in anode chemistry. One of the concerns is the larger volume of the sodium ion was not allowing as much storage in the anode. That looks like it's been solved, and we're looking at a real solution here in the power. So surely sodium ion will work well for power walls and megapacks. Yeah. And really that's where we're going, and where the cost savings is going to be. The entire economies of certain countries is probably going to be solved, or is probably going to be electrified by sodium ion batteries and megapacks. We're going to be using renewable energy when the sun is shining, when wind is blowing. We're going to be storing that energy at other times, and using peaker plants when none of that is working all that well. And if you're not familiar with energy technology, peaker plants for the most part are going to be natural gas fired. We still have tons of natural gas here in the United States. We are the Saudi Arabia of natural gas, essentially, and that's all due to fracking. I did a recent video on fracking, and how the fracking revolt really sort of upset the plans of Iran, Venezuela, and Russia in terms of dominating world geopolitics, because our up until 2008, we were producing about 5 million barrels a day of oil, and that number had been declining for 18 years straight. The fracking revolution comes along, and by about 2009, 2010, production starts to rise. It's up to close to 12 million barrels a day, and all of that, literally 100% of that, is due to fracking, and I can't even tell you how much is going on to into natural gas, and we're not done exploring for natural gas. We're not done even exploiting some of the resources that we know out there that do hold natural gas. But do I think that the EV manufacturing and charging stations will be negatively affected if a Republican president is elected? I do not. The market has already decided this. 12% of vehicles sold in California last year were electric. And I know that number is much smaller. When I visited Alabama last summer or the summer before that, there weren't many electric vehicles that were seen. But I'm seeing things today where I will see it on the freeway. It doesn't have exhaust pipes coming out of it. I come home, I look up what the car is, and boom, it's electric. There are all kinds of things that I've never seen before, never covered on one of my videos that are being sold here in California that are being used. People don't stay in California forever. A lot of people move away and they're going to take their electric vehicles with them. The people complaining about, about charging stations and all this, charging stations are not the issue, folks. People that own homes are going to be the primary buyers of electric vehicles going forward. And think about, and I think Bill Burr made a long, very hilarious speech about this that I'm not going to be anywhere near as funny paraphrasing it. But think about it, man. If you had a gas station at your house and you could fill up every morning, how many times during the week would you actually stop at a gas station away from home? And that's what you're facing when it comes to being able to charge from home. You're going to be able to use the same circuit that powers your electric dryer. The 230 or 240 volt circuit is going to be the one that is actually powering your electric vehicle as well. You're going to get home from work, plug it in, and in the morning when you leave work, your car is fully charged. So tell 666-999, thank you very much for the £2 super chat. I always enjoy those. It's always a nice cup of coffee for me. So I see Cindy says, this has been an issue since the 1990s, talking about the lack of skilled labor in the United States. Like Jason says, lack of training plus push towards white collar over blue collar, in my opinion. Yeah, we've done a really bad job of developing a couple of things going on here. Number one has been the decreased power of labor to organize over the years because of changes in politics. Number two has been sort of the denigration of skilled blue collar jobs. And it basically is lumping in skilled labor with unskilled labor, which I think is unfair. And number two, it's been the lack of appreciation for skilled labor. Like, I cannot tell you the amount of people that I've had over to my house, like right when we moved in, that said, "Oh, this place is like wonderfully redesigned. It was like really well done." And I could have gone through that house and probably pointed out 100 examples of sloppy workmanship in that house. They spent something like $250,000 remodeling the house before I moved in, before they sold it to us. And it was not worth it based on what they spent. They hired the cheapest labor. They made some of the dumbest mistakes on this house. Not anything that wasn't correctable, but just literally 100 little tiny errors that would have driven me crazy if I was a foreman on that job. We don't have the appreciation for skilled labor like we used to. And I think that was deliberately done to keep labor prices low. And some of that is probably changing at this point. We swung the pendulum a little too far in favor of the employer prior to the pandemic. And now that pendulum has swung a little bit further in favor of the employee, which I think is good temporarily. The balance needs to be tested in each direction occasionally. And I think this is one of those things that's going to be good for us as a society. Okay, guys, I've come to the end of questions and the end of things that I kind of wanted to talk about today. I do this live stream generally on Mondays and Thursdays. Sometimes I have to miss a day or two, and I generally put out about 1 or 2 videos a week talking about random economic stuff, man. There really isn't a plan for this channel. If you guys have something that you want to suggest, definitely go onto my community page on my channel, make a comment in there and suggest a topic for me, and I would be glad to target it. Yeah. So, okay, before I go, ChargePoint seems to be targeting apartment buildings in the Los Angeles area. Great idea. Because like I said, you're going to want to be where people are going or where people need it. People don't need it in suburbia. They need it in apartment buildings, and they need it where they're going. The other thing though, is I'm not a huge fan of stocks when it comes to charging infrastructure. And part of it is just because of how low the barrier to entry is and how destructive competition is going to be. Okay. So there is no barrier to entry when it comes to creating a charging station. It's a glorified plug. There's no technology that can't be replicated. There's nothing that is really patented in this case. So every single electrical component manufacturer is going to get into charging, and we're going to see charging companies pop up everywhere. And we're not going to know who the big winners are until we go through the era of consolidation. We're still a very long way away from that. I think ChargePoint and EVgo are both companies that are likely to either fail or to be acquired at pennies on the dollar by a larger competitor that jumps in the business once everyone else has exposed all of the weak points in it. So I am not a ChargePoint believer by any stretch. I do think there's going to be a lot of money to be made in charging. I just think that it's going to be a while before we know who that is. You see, thank you very much, Backbars. And question for chat: EVs may take over, but the ICE market will be fruitful, in my opinion. But used ICE market, yeah, I think it could be. That's not a business that I want to get into, though. One of these days, we got to talk about Carvana and that disaster and everything else that's going on in the used car market. It is something that has become a topic of conversation over the last 2 years or so that I never thought would be a topic of conversation, which is inflation in the used car market. I never thought a company like Carvana would be the hot stock that it once was. The fact that it has crashed like it has not surprised me that expectations, that reality couldn't meet expectations there. But all right, guys, I am taking off for the day. I will see you on Monday. Thank you very much, and you guys have a nice and safe weekend.